All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. And just recently, I am the co-founder of, as you can see here, Flip That Option that my business partner and I started. We launched it back in the beginning of May and got a strong response. And so that's the reason why I have not been making videos over these last, maybe 8-9 weeks approximately. And so, so you definitely want to check out that website as well, flipthatoption.com. And if you are interested in trading in a community environment, I think it's very powerful when you are able to trade with like-minded individuals. If you're looking for a community to trade with, again, definitely check out flipthatoption.com. And if you want to get in contact with me, send me an email at flipthatoption@gmail.com, and reach out to me. And if you're looking to trade with the community, we can definitely make that happen. All right, so today is it's Monday. It's July the 3rd. It's approximately 10:05 a.m. Eastern Standard Time, and because we have a holiday tomorrow, Independence Day, the market is going to be closing at 1 p.m. today. So we have an abbreviated trading session today. As you guys can see here, I am currently in a SPX trade. That's all I've been trading since May or June of last year, primarily doing 0 DTE, meaning 0 days to expiration. So the trade that I put on actually expires that same day, hence 0 DTE. However, because the VIX, or the fear gauge, if you will, the volatility index, has been extremely low. I mean, for the past, let me just look at so the last time it was at, it was essentially above 26, was in around, the beginning of this year, around the early part of March. But as you can see here, since over the last month or so, the VIX has been significantly below 20. And so as a result, the premiums that you can get for trading the SPX become really sparse, if you will, when you try to put a significant amount of distance between your short strike on the call side or the put side and the SPX itself. And so because volatility has been extremely low, it requires that you take more risk if you're looking to trade the 0 DTE option contracts. So as a result, I've been actually doing 1 and sometimes 2 DTE expiration trades on the SPX, which allows me to minimize my risk by putting more distance between my short strikes on the call side or the put side and the SPX itself. And so what I've been doing is I've been going into the market around 1:30, 2 o'clock, because that gives me a good perspective on the dominant move or the dominant direction of the SPX. And so if the dominant move is to the upside, and let's say, for example, like we saw on, what was that? Was it Tuesday? Let me just look at my spreadsheet here. Excuse me. Apologize for looking at my spreadsheet. I'm hoping you guys are keeping track. You guys who are trading options, you guys actually have a spreadsheet or some journal that you're utilizing to keep track of your trades, and also to write down any significant learning lessons that you make a note of during any given trading session. Right. So we saw a significant move on June the 30th. The market actually finished up a little over 1%. Right. And so because I come into the market later in the afternoon, I can see that, that significant move. I'm actually looking to put on a trade for the next expiration day, or maybe the day after that, maybe a 2 DTE expiration trade. And I'm looking to actually put it on in the direction in which SPX is moving, because a move over 1% in one day for the SPX, that's pretty significant, right? And so you can pretty much, with high probability, expect for the SPX not to have that same significant move for the next day, right? And so it may have a slight pullback, or it may trade slightly sideways. But nonetheless, if you trade within the direction that the underlying is moving, underlying in this case being SPX, then as he's moving up, then the strike prices, or the premiums for those strike prices on the call side, because he's moving up, are going to be rather meaty, if you will, are going to be, much more than the premiums on the put side, if you're looking to put distance between your short strikes and also the SPX. So I hope that makes sense. So I like to trade in the direction in which the SPX is moving. So if it's going up, I'm on the call side. If it's dropping down, I'm on the put side. But again, because volatility has been low, I'm looking to do a 1 DTE or also a 2 DTE trade. And I'm always keeping track of the closing price of the SPX, because if it's been up, for example, if it closed up, 2 consecutive days, then there's a high probability it's going to pull back on that third day. Now, of course, June the 8th through the 15th, we had we had 6 consecutive days where the SPX actually closed up, right? So that's rather, just based upon the information that I've been keeping, it's rather unusual. You don't see that very often, but nonetheless, it does happen. And so just maintaining information. And of course, you get this information from Yahoo's website easily, right? You can get historical information from Yahoo's website, but nonetheless, I always keep track of it. And again, it just helps me. It gives me a market awareness, right? Market awareness of what's happening in the market, and it gives me, a good idea of where I need to be, whether I need to be on the call side or the put side for that 1 or 2 DTE expiration trade, right? So I put this trade on again on June 30th, and I took a credit of $330. As you can see here, I made the entire $330. Of course, it's an unrealized gain until I close it out or it expires, and so I'm not going to close it today, considering that the market closes at 1 p.m. And so I'm just going to let the I'm going to let the position expire. As we can see here, I mean, the SPX is at a significant distance away from my position, so I don't feel any threat whatsoever from the SPX with respect to this position here. Right, and so as we can see here, if we look at a 5-minute chart of the SPX, we can see that the Bollinger, I like to use the Bollinger Bands, right? So the Bollinger Bands are like guardrails, if you will. And so the mathematical principle behind the Bollinger Bands actually, and this is the way I describe it, it actually states that the underlying in this case, the SPX, essentially has to stay within those Bollinger Bands, right? And so anytime the SPX moves outside of these Bollinger Bands, if the Bollinger Bands do not accommodate or adjust to that move to the outside, whether it be beyond the upper Bollinger Band or the lower Bollinger Band, then what you'll see that the SPX will actually start to work its way back inside of the Bollinger Band. So I look at the Bollinger Bands as being like guardrails, if you will, when you think about, you driving your car on the highway. Nevertheless, so as you can see here, the guardrails of the Bollinger Bands are pretty contracted, right? Conveying that we should not expect much movement from the underlying SPX, at least at this particular point, right? And I kind of figured that because we are going into a holiday tomorrow, that the market would be pretty calm. And also, this is a time of year where a lot of these guys who hit up these large institutions that actually move the market, they go on vacation, right? So there's a saying that, sell in May and go away. In other words, you want to sell your positions in May because everybody goes on vacation shortly thereafter, and supposedly there's not a lot of liquidity in the market. So you get these really volatile moves, if you will, because these large institutions that really provide the liquidity, the folks who run these institutions are actually on vacation. But I don't know how true that is, but nevertheless, but again, the SPX looks like it's going to be moving sideways pretty much the entire abbreviated trading session today. And the other thing I like to look at, and I think I mentioned this before in previous videos, if you've been following me for some time, is I like to look at the 11 sectors that make up the S&P 500. And of course, the SPX is the index that tracks the S&P 500. And so I like to look at the 11 sectors because obviously the 11 sectors are, to use a human analogy, the 11 sectors are like the anatomy of the SPX, right? So without the 11 sectors, there would be no SPX, because the SPX consists of the 11 sectors, and the 11 sectors are weighted, right? And so the XLK, which is the tech sector, has the largest influence on how the SPX moves, okay? So it has roughly around a 27% or 28% weight with respect to the other 11 sectors. And so it has the largest weight, and the two publicly traded companies that have the largest weight, when you look at the 500 companies that make up the S&P 500, the XLK, so you have Microsoft and you have Apple, right? So Apple has a weight of roughly around a little over 7%, and Microsoft has a weight in the S&P 500 of over roughly 6-point-something%. So those two publicly traded companies by themselves have a combined roughly 14% influence, right, on how the SPX moves. And those two stocks are contained in the tech sector, XLK, right? So they can so those two companies by themselves can actually, move the market pretty significantly, right? So I'm always looking to see whether or not XLK is in the red or in the green. And anytime you see the SPX making a significant move to the upside, you can best believe that the XLK is going to be over, over 1%, to the upside in the green. And then the next sector that makes up that has the next highest weight, or the next major influence on how the SPX moves, is the XLV sector, right? So the XLV sector has roughly about a 14% influence or weight on the market, and so that's the healthcare sector. And so again, I'm always looking at the XLV and also primarily the XLK. And then you have the other sectors like XLF, which is the financial sector, right? It has about an 11% influence. You have XLY, which is consumer discretionary, that has about a 10% influence. Then you have XLC, which is where Meta, formerly known as Facebook, is located. That has about a 8 to 9% influence. Then you have XLI, which is the industrials. It's about a 8% influence. XLP, consumer staples, 6.5%. You have XLE, which is the energy sector. It's about 4.8%. XLU, utilities, about 3%. And XLB, which is materials, that's about a 3%. And then you have XLRE, which is the real estate sector. It has about 2.8%. So again, your major sectors that you want to keep track of are your XLK, which is the tech sector, and XLV, healthcare, and XLF, which is the financial sector. So those three sectors together have a major influence on how the SPX moves, right? Yeah, so again, as I mentioned before, guys, we have an abbreviated trading session today, so the market will be closing at 1 o'clock. But nonetheless, I hope you guys are doing well in your trading. And again, if you want to trade within a community setting with like-minded individuals, definitely check out flipthatoption.com.